progress.
A very good morning to you all, friends. I am Sanjeev Singhal, Central Council Member, Chairman, Auditing and Assurance Standard Board. I welcome you all to this 133rd program of AASB for this council year. Friends, we have been organizing the topics on, the webinars on various topics, and it's been our endeavor to cover a very wide spectrum of the topics. Today's topic is audit of the non-corporate entities, the special consideration into that. And to take this webinar, we have two very esteemed speakers, CA Pranav Jain and CA Praveen Kaushik ji. They are extremely good speakers, well experienced, and I'm sure that you will be benefited from their experience. To moderate the session, we have Kajal Garg and Swati Kapoor. I'm thankful to all four of them, both our speakers, Pranav Jain and Praveen Kaushik, and the moderator, Kajal Garg and Swati Kapoor, for taking out their precious time. And special thanks to all the audience also for showing their keen interest in the learning. I'm sure that this will be a very beneficial program, and the participants will go back with very enriched experience, and they'll be able to apply the auditing principles to the audit of non-corporate entities, even in a better manner than what they used to do earlier. Friends, AASB has been taking many initiatives. Apart from these trainings, we are also running an expert helpline whereby you can ask your queries relating to statutory audit with our experts. We have 50 experts, and they reply to all the queries pertaining to audits. Similarly, we have issued a audit standard checklist and a working paper templates. Kindly make use of them. Our Center for Audit Quality has also brought out many useful publications on SQC, engagement letter, and other matters. We have also done a tie-up for an audit tool, whereby the audit tools are available to smaller firms at a very significant discount. And the Institute has also given a practice management software, which is free of cost for all the COP holders. Kindly make best use of them to the extent you find that these are relevant for you. This journey of quality is a combined journey, and we must undertake it on a continuous basis so that we keep delivering on the high quality audits. With this, may I now invite Kajal for taking the session forward. Thank you.
Hi, good morning, everyone. Today we are organizing 133rd CPE program of AASB. Thank you so much, everyone, for attending this webinar. It's my honor to extend a warm and heartfelt welcome to our esteemed chairman of AASB, CA Dr. Sanjeev Kumar Singhal, who joined us today for this webinar, and also vice chairman of AASB, CA Vishal Doshi. He is absent today. Thank you for all being here today. We are about to delve into an essential aspects of auditing, the key considerations in the audit of non-corporate entities. Non-corporate entities include non-profits, cooperatives, trusts, and similar organizations operate under different framework and have unique operational characteristics compared to traditional for-profit organizations. These differences include specific considerations and challenges for the auditors. So it's my pleasure to introduce CA Pranav Jain, our guest speaker for today's webinar. He is a fellow member of ICI in practice within 24 years of experience in audit and assurance, both in India and abroad. He has completed certificate courses of ICI on IFRS and forensic accounting and fraud detection. He is a regular speaker at various forums, including those of ICI and PhD chambers of commerce in industry. He is empaneled as a technical reviewer with Quality Review Board set up by Government of India. He has authored a book, Audit of Financial Statements, which has been published by Taxman Publications. The third edition of the book has been recently released. Thank you, sir, for attending this session. And now I would like to invite Ms. Swati, my co-moderator, for continuing the further session.
Thank you so much, Kajal, for such a detailed explanation.
So, forward, I am delighted to introduce our second guest speaker, CA Praveen Kaushik. Praveen ji has over 18 years of experience in IPO advisory services, IND AS, IFRS advisory services, audit and assurance services, and fund management services. He has a successful steered in 6 IPOs in different capacities and role, and currently advising some of the big business houses in their IPO journey. He also specialized in valuation and has immense experience and knowledge in business valuation, equity valuation, and many more. So I would like to welcome Praveen Kaushik ji. Now I would like request Pranav Jain ji to start his session. Thank you so much. Sir, you are in mute. Thank
Good
you.
morning to all. First, I'd like to thank the Auditing and Assurance Standard Board for providing an opportunity to share my thoughts on key considerations in the audit of non-corporate entities. Thank you, Kajal and Swati, for the introduction, and welcome to our fellow speaker, Praveen Kaushik. Uh, Let me share a presentation. Uh, so, as was introduced, this non-corporate entities have typical issues when audited as compared to the audit of corporate entities. But having said that, the basic principles of auditing remain same, whether it's a corporate entity or a non-corporate entity. There are certain differences, but we will try to cover some of the key aspects of auditing. And the other part relating to accounting standards and the format of financial statements will be covered by my fellow speaker, Praveen. So I will be covering the background of non-corporate entities, the legal framework for the audit of non-corporate entities, and look at some of the key auditing standards which are applicable to non-corporate entities. Focus on two key standards because these are the most critical standards from the regulatory perspective and from the audit perspective. So as we know, businesses can be carried out either through a corporate entity or a non-corporate entity. When we talk about non-corporate entities, some of the common non-corporate entities would be sole proprietor, partnership firms, LLP, trust, HUF, association of persons, societies, cooperative societies. So each has typical issues. However, again, the audit that is similar with whatever the size of the entity or the form of the entities. So coming to the legal framework, the corporate entities are mandated by Companies Act to have audit done. In case of non-corporate entities, they may or may not be any mandated under any governing law. In case of LLP, the accounts are to be audited if the LLP's turnover exceeds 40 lakhs or contribution exceeds 25 lakhs, then the accounts are required to be audited. Otherwise, if the threshold limits under Income Tax Act are met, then there is a mandatory tax audit. And once a tax audit is mandatory, the audit of financial statements is also required. And in this case, the audit report is given in Form 3CB, which has two parts, one covering the financial statements, the other part covers the tax audit, Form 3CB. When we come to the basis of accounting, generally two bases of accounting are commonly followed and acceptable. The accrual basis of accounting, also referred as mercantile system of accounting, and a cash basis of accounting. For companies, accrual basis of accounting is mandatory in the Companies Act 2013. Section 34, subsection 1 of the LLP Act 2008 gives LLPs an option to follow either a mercantile system or a cash basis of accounting. For other non-corporate entities, there is no stipulation as to the basis of accounting. The Income Tax Act allows both accrual as well as cash basis of accounting. Very recently, the Institute of Chartered Accountants of India has issued a technical guide on the cash basis of accounting. So if we go through that technical guide, it recommends a slightly modified cash basis of accounting, meaning That recognition of non-cash items such as depreciation, impairment of assets, write-down of inventory, etc., is needed to be done even if the entity is following a cash reserve accounting. So, for example, an entity has given a loan and to some party, and that party has now run away or is absconding, then an impairment of that a provision against that loan needs to be recorded, although it is a non-cash item. The technical guide also states that the non-corporate entity shall follow accounting standards as and when and to the extent these are applicable to them. The elements of financial statements, such as assets, liabilities, income, and expenses, are to be recognized on receipt and payment basis, subject to meeting definitions of the relevant items and meeting the relevant recognition criteria under the framework and the accounting standards. So even if an entity is following a cash reserve accounting, an asset would be recognized as an asset only if it meets the recognition criteria as per AS10. But coming to the auditing standards. Now, the second schedule of the Chartered Accountants Act 1949 states that a member in practice shall be guilty of professional misconduct if he fails to invite attention to any material departure from the generally accepted procedure of audit. So this Chartered Accountants Act actually mandates an auditor to ensure that the audit of a non-corporate entity is also carried out in a manner similar to the audit of a corporate entity, which is mandated under the Companies Act and as per the auditing standards issued by the Institute of Chartered Accountants of India. So it is mandatory for the auditor to ensure compliance with the standards on auditing. It is notable to note that International Auditing and Assurance Standard Board issued an international standard on auditing for audits of financial statement of less complex entities. So it is a slightly abridged version of all the standard in auditing. Our institute's Auditing and Assurance Standard Board has also issued the exposure draft of a similar standard on auditing for audit of less complex entities. The exposure draft is right now open for public comments, and the last date for that is 9 September 2024. However, till the time the standards on auditing for audits of financial statement less complex entities becomes applicable, all existing standards on auditing are applicable and mandatory even for the audit of non-corporate entities. Now, it may be important to mention that uh, when the standards on auditing were revised by the International Auditing Standard Board, they had introduced the concept of scalability, meaning that the auditing standards can be applied to a wide range of entities, and the size and the nature and complexity of the entity would automatically align with the compliance requirements of the auditing standards. A similar approach has been given in the proposed new auditing standards, which have not been issued as yet, but have been approved by the Auditing Standard Board. So, in these new standards, particularly 315, 540, you would find a separate paragraph on scalability, meaning these can be applied to a wide range of entities. To enable the auditors of small and less complex entities, the Institute has also released two publications. One is a ready referencer on engagement and quality control standards, and another is the Practitioner's Guide to the Audit of Small Entities. These both publications are very useful and can assist an auditor of a small entity, whether it's a corporate entity, non-corporate entity, in carrying out the auditing procedures. So now I will focus a bit on the standards on auditing, and I will focus on some of the key standards which are very critical for the audit of non-corporate entities. But first, an overview. So at present, there are 46 standards under the category Engagement and Quality Control Standards. The first standard, or we can say the mother of all standards, is standard on quality control. So every audit firm or a proprietor who is performing an attest function and providing assurance services is mandatorily required to follow and comply with the standard on quality control 1. So it is not important that whether, it may be a case where a practitioner is auditing only non-corporate entities, but that does not make a difference. SQC1 is mandatory. And it is worthwhile to note that the QRB, Quality Review Board, which normally reviews the financial statements of corporate entities only, has found significant deficiencies in the compliance of SQC1. So this is one area where the auditors need to focus, irrespective whether they are doing audit of corporate entity or non-corporate entity. Standards in auditing, there are 38 standards, 2 standards on review engagements, 3 standards on assurance engagements, and 2 standards on related services. So, standard 38 auditing standards, they are divided into various series. So 200 to 219 series is general principles and responsibilities covering 9 standards. 300 to 499 has 6 standards related to risk assessment and response to assessed risk. 500 series is 11 standards on audit evidence. There are 3 standards on using the work of others in 600 series. 700 series has 6 standards related to audit conclusions and reporting, and 3 standards on 800 series related to specialized areas. So risk-based audit is one area where I would like to focus, because there is generally a misconception that audit of a non-corporate entity can be done in a traditional manner. It may be worthwhile to note some of the non-corporate entities are huge, have a significant business volume and transaction, and are as good as a corporate entity. And the auditing standards prescribed by the ICAI are on a risk-based audit approach. So it is very important to understand the risk-based audit and effectively audit non-corporate entities. So auditor's objective in a risk-based audit is to obtain reasonable assurance that no material misstatements, whether caused by fraud or errors, exist in the financial statements. So it has a 3-step approach. 1, assess the risk of material misstatement. Design and perform audit procedures that respond to the assessed risk, and issue appropriate audit report based on the audit findings. Now, why reasonable assurance? 1, the audit is carried on a test basis. There are limitations of internal controls. There may be frauds which remain undetected. The nature of the audit evidence available, availability of audit evidence, the professional judgment that the auditor makes in the course of audit, difficulty in ensuring completeness. So these are some of the reasons where, why we only have a reasonable assurance and not an absolute assurance when doing an audit under a standard of auditing. So our objective is to mitigate the audit risk. So what audit risk actually means? That the risk that the financial statements contain a material misstatement, and the risk that the auditor will not detect such a misstatements. So if we look at the audit risk, we have a control risk, we have an inherent risk, and we have detection risk. And at the intersection of these 3 risks lies the audit risk. So quickly, some definitions. Inherent risk is a susceptibility of an assertion to be a misstatement that could be material, assuming that there are no related controls. Control risk, entities' internal control system will not prevent or detect and correct on a timely basis a material misstatement. And a detection risk, that the auditor will not detect a misstatement. So in the next few slides, I will try to link the audit, risk-based audit, to the standard auditing, covering a few important aspects and considerations that the auditor of a non-corporate entity should keep in mind. So right at the beginning of the audit is the setting of objectives, which is linked to series 200 to 299. So appointment and reappointment formalities, this should be done even in the case of non-corporate entities. Without a formal appointment letter, the auditor should not normally proceed with an engagement. Considering client acceptance and re-acceptance, this is a very critical audit procedure. Even the Standard and Quality Control 1 requires an auditor to assess whether the clients need to be accepted, or in case of a continuing client, whether there are any issues in re-accepting the client. So this is something which is very critical, and the QRB has also noted some non-compliances with the acceptance and re-accepting procedures carried out by audit firms. Because the risk in a non-corporate entity could be similar to a risk in the audit of a corporate entity. So that is why it is important. Uh, Identifying the scope and understanding the terms of audit engagement letter. So essentially, the auditor should obtain an engagement letter. Very recently, the institute has released an Excel utility, Excel and Word utility, wherein the auditor just needs to fill in certain details, whether it's a corporate entity, non-corporate entity, the auditing standard, accounting standards applicable financially and in the entity, and it would generate a customized engagement letter. So it is available on the website of the institute. So I think all auditors should, you know, download those utilities and use it extensively, because it's a very comprehensive engagement letter covering all aspects of SIT related to engagement letter. Calculate and document materiality. Again, materiality is very critical to perform audit procedures, to have an appropriate sample size, to assess the misstatements that are identified so as to ensure the correctness of the audit opinion. And then understanding the scoping in a financial statement. So based on the materiality and performance materiality, the auditor needs to assess which all financial statement areas need to be scoped in the audit, or which can be bypassed, or very limited procedures be performed in certain areas. Identifying and assessing risks, again, SA 300 to 499 series. Now, identifying risk through understanding the entity and its environment, including internal controls. This is at the core of the risk-based audit, and this is coming from SA 315. So the auditor has to go through the requirements of SA 315 and identify the potential risk from material misstatement, and then assess those risks and perform the audit procedures according to the assessment made. Risks are identified through procedures like preliminary article review, discussion with the client, reviewing internal audit reports, among other matters. So there is a detailed guidance in SA 315. Preliminary article review is very critical in the sense that it highlights certain abnormal variations or ratios, indicating the areas of focus for an auditor. Internal audit reports may not be applicable in most non-corporate entities. However, some non-corporate entities have voluntary internal audit system. So wherever that internal audit reports are available, the auditor should obtain those and review the findings of the internal auditor. Then basis that is identified, these risks should be assessed both qualitatively and quantitatively before the potential risks are actually termed as risk. We will see a little bit of it in the subsequent slides. Then based on the risk assessment, the auditor needs to develop an appropriate audit strategy. So this will mean an appropriate use of test of control, substantive analytical procedures, and other substantive procedures while ensuring both audit efficiency and effectiveness. So we will discuss this in more detail in a subsequent slide. Engagement team discussion and planning matters. Again, this is very important and mandated by SA 315. Again, NAFRA and QRB have both, in case of corporate entities, identified gap that there was inadequate engagement team discussion. The objective of engagement team discussion is to ensure that the key team members, partners, seniors, and others, are aware of the materiality, the risk of fraud, the risk of material misstatement, the audit strategy, so that they can drive the audit in an effective manner and complying with the standards on auditing. So this is one area which is relevant for all types of entities, whether it's a corporate entity or a non-corporate entity. Again, at the planning stage, a review has to be done by the senior in charge and the partner in charge to ensure that the planning has been done appropriately, because a sound planning will ensure an effective audit. Uh, this 500 series talks about the audit evidence. So the audit evidence can be in the form of test of control, substantive analytical procedures, and other substantive procedures. Important to mention that the auditor should obtain external confirmations wherever applicable. SA 501 requires the auditor to mandatorily participate in the observation of physical inventory. That is a procedure that where the non-corporate entities dealing in stock items, the auditor should ensure presence at the inventory count, and that's the key procedure. Uh, the manage the working papers effectively and efficiently. Whatever audit evidence is obtained should be properly documented, and it should reflect the nature of work done and the conclusions reached on various financial statement areas that have been audited. Uh, Using the work of others. So basically 600 series talk about using the work of other auditor, using the work of auditors experts, and using the work of internal auditor. Uh, when we talk about using the work of experts, there may be cases even in non-corporate entities where the auditor engages specialists like IT specialists or valuation experts or uh, tax experts to assess the litigations or assessing the internal ITGC controls. So there, the auditor needs to ensure that there is appropriate understanding of the use auditor expert as per the SA. As I mentioned, there may be cases where there is an internal audit, even in case of a non-corporate entity. So where the auditor plans to rely on the work of the internal auditor, the auditor should ensure compliance with the relevant auditing standard. So next is the most critical part, uh, the opinion reporting covered by SA 700 series. Uh, so whatever the findings, observations the auditor has noted in the course of audit should be discussed with the client, explanations to be obtained, any supporting documents that are needed to address the management responses should be well documented. And basis that the auditor should form an opinion after considering relevant judgments, ensuring that all with misstatements identified have been either adjusted or are under the maturity levels before a modified before unmodified opinion is issued. And if the impact is material, then the auditor should consider issuing a modified opinion. So we will look at this aspect also in a subsequent slide. And obviously, the documentation has to be completed before issuing the audit report. So I'd like to focus a little bit on identifying and assessing risk because this is at the core of audit and a very critical area and relevant for all types of entities. So when we talk about risk, there's a three-stage approach: identify the risk, assess the risk, and respond. So risk identification can be done by understanding the entity. The guidance is given in SA 315. I've already discussed a bit. Preliminary analytical review is also a very critical part. It will throw up some normal variations that may be there in the financial statement. So the auditor would know which areas require special attention. Control risk. Now, understanding the internal controls. It is quite possible that in non-corporate entities, there is no formal internal controls. So our audit strategy will depend upon our assessment of internal controls. The IT environment is very critical to be understood because there are non-corporate entities which have a complex IT environment. They are using advanced software like SAP or Oracle. So in case the IT environment has been assessed as complex, the auditor will need to ensure that there are IT specialists who assess the IT environment, do ITGC testing or other testing. Even though the requirements of audit trail are not applicable to non-corporate entity, but testing of IT environment is still required and it will impact the overall audit strategy. So if we look at the risk, so we start with identifying potential risks based on understanding the entity, understanding internal controls, IT environment, and then also the ethical review. And these risks are broadly categorized into entity level risk and assertion level risk. In a non-corporate entity, there is a high likelihood having entity level risks because of generally these non-corporate entities have less organized structure, and in some cases they are promoter driven. So, the entity level risks are likely to be high in case of a non-corporate entity, and this would definitely impact the overall audit strategy. And then these risks are further classified as normal risk, significant risk, or in some cases, the firms may decide it's an audit plan reminder. So they are not identified to be a risk, but they would keep, say, for example, substantially high legal expenses. So it may not be a risk in itself, but while doing the audit of legal and professional expenses, the auditor may want to have a special focus to identify any potential contingent liabilities or claims against the company that may have been there. Uh, Having assessed the risk as normal, significant audit plan reminder, and assessment of internal controls, the auditor shall plan the audit procedures to mitigate the risk. So when we assess a potential risk, whether it's a risk of material misstatement or not, we consider two factors. One is likelihood and the magnitude. So if both likelihood and magnitude are there, then it is generally a risk of material statement. So I will give an example. Say, for example, in a retail store, there is a high volume of cash transactions and there is a high probability of misappropriation of such cash. So in this a retail store, a cash may be a high risk of material misstatement. Consider, for example, entity which is net worth of 20 crores and a significant turnover of, let's say, 10 crores. There is a cash in hand of around 50,000, and there is no procedure of regular verification of cash, and which is in the custody of a cashier who has been there for quite some time. So, although the likelihood of defalcation of this cash may be high, but the magnitude, considering the size of the entity, is not too high. So, probably this will not be considered as a risk of material statement by the auditors. So it is not necessary that all potential risks will actually convert into a risk of material misstatement. So the test is both likelihood and magnitude, and that is the impact on the financial statements. Now, SA 240 talks about two presumed risk of material misstatement, which is very important to understand. And these are equally applicable to the audit of non-corporate entities. What these standards says is there is a rebuttable presumption, so that you assume that there's a risk and uh, then perform procedures or document why this is not likely to result in a material mistake. So the first presumed risk is revenue recognition. So it is the most common form of fraudulent financial reporting. It could be understatement of revenue or overstatement of revenues, depending upon the circumstances. If they want to evade taxes, it would be understatement of revenues. If they want to uh, go for some funding, it might be overstatement of revenues. So both can be a risk. So some of the common schemes are recording of fictitious revenues, prepayment, postment of revenue, recognition of revenue, products and services are not delivered or partially delivered in case of bundled contracts, uh, recognition of revenue from sales transactions billed but not shipped, recognition of revenue from excessive shipments to resellers beyond actual demand, channel stuffing. This is very common, particularly in retail industry. Improper recognition of revenue from long-term contracts, including those accounted using percentage of completion method. The second most common, second presumed risk as per the auditing standards is the management overhead of controls. So management, by virtue of their powers, is in a unique position to perpetrate a fraud because they can directly or indirectly manipulate accounting records. Uh, it is more likely in entity which operates on a small scale and have lesser controls in place. So typically, a non-corporate entity may have a less formal control system, and there may be higher chances of management overhead of controls. Uh, the level of risk of management override of controls will vary from entity to entity, but this risk is present in all entities. Uh, how management can override controls is by recording fictitious journal entries, particularly close to the end of an accounting period, inappropriately adjusting assumptions and changing judgment used to estimate account balances, omitting, advancing, or delaying recognition in the financial statements of events and transactions that occurred during the reporting period. So some of these methods, there are multiple ways in which management can override a control. So we have to be conscious of fact that this is a possibility and this is a mandatory requirement under SA 240 to address this particular risk. Now, coming to a very important part of this is designing the audit strategy. We have assessed the risk. We have classified the risk as significant, normal, or audit plan reminder. We have understood what is the presumed risk. We have understood the internal control environment. We have understood the IT environment. And basis that, we now need to develop an appropriate audit strategy to carry out the audit. So the nature, timing, and extent of audit procedure will depend on our understanding of internal controls, which are both at the entity level and at the activity level within the cycles, and the level and nature of risk identified. The audit procedures should be designed to ensure both effectiveness and efficiency, and with the objective to reduce the audit risk to an acceptably low level. The audit procedures will be a combination of test of controls, substantive medical procedures, and other substantive procedures. So in the next slide, I have a small table which summarizes how it will be affected. So if the auditor is testing operating effectiveness of controls and the controls are operating effectively, we have a high control assurance, and thus the level of substantive procedures can be reduced significantly. There's a low level of substantive procedures required. Controls are not the controls are not operating effectively, and uh, so there are no control assurance, and high level of substantive procedures would be required. And if we decide not to test operating effectiveness controls, but have concluded that controls have been designed and implemented properly, we get a low assurance of control and we need to perform a moderate level of substantive procedures. And in case the design and implementation is not appropriate, then there is no control assurance and the auditor would require a higher level of substantive procedures. This is a case of non-specific or significant risk identified. So if there is significant risk identified, this scenario will change. Next important topic that needs to be considered in the audit of non-corporate entities is SA 230 documentation. It is important to mention that both NAFRA and QRB, in their review of audits of non-corporate and of corporate entities, have found significant deficiencies in documentation by the audit firms. So it is very important to mention that even though audit of non-corporate entities are outside the purview of NAFRA and QRB, there is still a peer review of audit firms that is required by the institute. And over the period of time, institute has significantly widened the coverage of audit firms requiring peer review in a phased manner. So it is likely that even if you are doing audit on non-corporate entities only, depending on the number of partners, you may be required to have a peer review. And this is where documentation would be very critical to obtain a peer review certificate without any comments. So quickly, scope of SA 230. It is the auditor's responsibility to prepare audit documentation for an audit of financial statements. It is to be adopted as necessary in the circumstances when applied to audits of other historical financial information. And specific documentation requirements of others auditing standard do not limit the application of this auditing standard. So there are certain auditing standards which require specific documentation to be done, but that is separate. The requirements of this standard are to be complied with in any case. Right. Um, so audit documentation is to maintain at all the three stages of audit work, that is audit planning, audit execution, and audit reporting. So we have discussed the part in audit planning, execution, and reporting that before the audit report is issued, all documentation should be complete and reviewed. So this is critical. So quickly, why documentation is important? There may be firm policies, the compliance with applicable social standard, including SQC 1, SA 230, applicable regulatory and legal requirements. It is evidence, internal reviews, manager review, partner review, board review. So, even if you are doing an audit of a non-corporate entity, the working papers need to be reviewed by a manager or a partner before the audit opinion is issued. And SQC 1 also requires a system of internal reviews post-audit to ensure that the standard requirements and the form policies are complied with, which are commonly referred to as code reviews. So this is also important from the perspective of SQC 1. Regulators, NAFRA, QRB, SEBI, yes, maybe not applicable for non-corporate entity, but as you mentioned, uh, peer review by ICI is one area which will require a documentation. And others, in case there is a litigation, it is a documentation of audit file, working papers that will be helpful to the auditor to demonstrate that the audit was carried out in an appropriate manner. Form and content of documentation will depend on factors such as size and complexity of the entity. So if the entity is small and less complex, the documentation will also be simpler. The nature of the audit procedures to be performed. So in case, for example, if you are able to obtain 100% confirmation from debtors, so that will be a different documentation. If the confirmations are not received, then the alternate procedure will be formed. So the documentation will depend upon the nature of the audit procedure performed in this case. The identified risk of material statement and the significance of audit evidence obtained. So based on the risk assessment, what specific procedures were performed to address the risk of material misstatement? So, say for example, cutoff testing for revenue. So there will be that has been identified a significant risk of material misstatement. So appropriate procedures would need to be performed to address those risks, and obviously documentation will vary according to the audit evidence specifically obtained. The need to document a conclusion, the basis of conclusion not readily determined from the documentation of the work performed or audit evidence obtained. And the audit methodology and tools used. So some firms may be using audit tool or a software, and the checklists are built in, and the methodology may also prescribe certain form and content of documentation to be maintained. SA 230 says that the documentation should be such that it should have sufficient evidence to allow an experienced auditor with no previous connection to the audit engagement to understand the audit procedures performed, evidence obtained, significant matters arising during the audit, conclusions reached, including significant professional judgments made, and who performed the work and when. So, for example, uh, an ex-auditor has conducted an audit of White Trust and has maintained documentation. Now, I, as an experienced auditor who has never done the audit of White Trust, and I'm reviewing the file of the audit work papers for White Trust, I should be able to understand what procedures were performed by the audit team, what was the evidence they obtained for various financial statement areas, what significant matters were identified in the audit and how these were resolved, and what conclusions were reached and what professional judgments did the audit team make during the course of audit, and who performed the work and when that work was performed. So this should be a speaking work paper basically, so that anybody. So in case of a regulatory review, that person need not sit with the person who performed the work. Should be able to understand the documentation on its own. Uh, what to document? The audit procedures applied, that is what was the objective, procedure, results, and conclusions, details of tests performed, describe in detail what was the work performed. This can be done through checklists also. Identify the person who performed the work and those who reviewed it, including the date when these were performed. So it is very important to mention that one of the NAFRA orders, this has been identified as a significant gap, that it was not mentioned who performed the work and when it was reviewed. So that is a critical documentation requirement. Identify the significant matters arising during the audit, the conclusions reached and the basis for the conclusion, the sources of amounts and other information. So, for example, if you are valuing disclosing the quoted investments, the market value, there should be a documentation of the share price, maybe a screenshot that this is where from you have taken the price for the valuation for the disclosure of market value of quoted investments. Properly index and cross-reference, and the audit procedure performed according to the instructions in the audit program. Ensure all procedures in the audit program are addressed in audit working papers. So many firms have audit programs for various financial statement areas. So it should not, if any procedure is not applicable, it should be clearly mentioned why it is not applicable. Otherwise, it should be ensured that all procedures in the audit program are addressed to ensure that the audit procedures have been appropriately performed. What to document? This is very critical. Only the work the auditors actually perform, only what is relevant to the audit should contain analysis, opinions, conclusions, and supports the overall audit opinion. Equally important is to understand what is not documentation. Entity requires, for example, invoices looked at in testing. So, there is a common practice of obtaining copies of all the fixed assets additions. That is not actual documentation or documentation. What you need to do is document in detail in an Excel worksheet or a work paper at what invoices were checked. The details of the invoices may be noted, but keeping copies of invoices is not a documentation. Superseded working papers and drafts, these should be discarded from the file because they will create confusion and may have potential risk. Notes that are incomplete or reflect the preliminary thinking. So, we may be making some audit file notes and these are not complete. So, these should not be a part of the file. Previous copies of documents corrected for typographical errors or other errors. So, there may be cases where you had a copy of a financial statement which had a lot of errors or audit report which had typographical errors. Now, these have been corrected. So, previous copies need not be retained. Duplicates of documents. So it may be possible that certain documents are relevant in two different sections of the file. So there can be a cross-reference instead of having two copies of the same document in the file. And if there is uncertainty as to what to keep on file documentation, you should always ask your field senior manager or a partner. Some of the characteristics of high quality working papers. Essentially, there are five characteristics of a high quality working papers. Completeness. Each work paper should be completely self-standing and self-explanatory. As I mentioned, that the giving example of the experienced auditor should be able to understand the documentation without having the need of a preparer to sit along with. Accuracy. High quality work papers include statements and computations that are accurate and technically correct. Work papers should have a logical system of numbering and a reader friendly layout. So, a technically competent person unfamiliar with the project could understand the purpose, procedure, performance, and results. And relevance and conciseness. The audit work papers and items on each work paper should be relevant to meeting the applicable audit objective. So in case of small and less complex entities, documentation would be generally less extensive. The auditor may record various aspects of the audit together in a single document. For example, understanding the entity and its internal control, the overall audit strategy and audit plan, materiality, So they can be a single work paper to document key aspects. So before I conclude documentation, it's very critical to know that work not done, not documented is work not done. Um, Quickly go through some of the key aspects of auditor's report and related standards in auditing. Um, So the following are the auditing standards that are applicable as far as reporting is concerned. So SA 700, which is applicable to all entities. 701 applicable only to listed entities. 705 applicable to all entities. 706 applicable to all entities. 710 again applicable to all entities. 720 all corporate entities. Some other relevant auditing standards related to audit report. SA 240 SA 260, 320, 570, and 580, these are all applicable to all entities. So when preparing an audit report for a non-corporate entities, the auditor should consider all these standards. So it is important to understand the audit opinion may be modified or unmodified. So in case of modified, which is governed by SA 705, it can be a qualified opinion, adverse opinion, or a disclaimer of opinion. An unmodified opinion will be have either no comments or emphasis of matter, which is as per SA 706. We'll quickly look at so financial statements are materially misstated, and it is only material. It will be a qualified opinion. It is both material and pervasive. It will be an adverse opinion. Uh, if the auditor is unable to obtain sufficient appropriate audit evidence, it is material, it will be a qualified opinion. And if it is both material and pervasive, it will be a disclaimer of opinion. So this is important even for a non-corporate entity. SA 701, SA 700 prescribes the format of an audit report. So what SA 700 says is the auditor's report shall be in writing. It should have a title that it's clearly mentioned that it's a report of an independent auditor. Addressee, the auditor's report shall be addressed as appropriate based on the circumstances of the engagement. In case of company, it is addressed to the members. In case of a partnership firm, it will be addressed to the partners. In case of a trust, it will be addressed to the trustees of XYZ Trust. It will be followed by an opinion paragraph. If the opinion is modified, the heading will be appropriately changed to qualified opinion, adverse opinion, or a disclaimer of opinion, as the case may be. It will be followed by a basis of opinion paragraph. In case of a modified opinion, the heading will be basis for qualified opinion, basis for adverse opinion, or basis for disclaimer opinion, as the case may be. In case the auditor has an issue with going concern in terms of SA 570, there will be a separate paragraph on going concern, which is material uncertainty related to going concern. Then there would be an emphasis of matter paragraph, if applicable, which will be in accordance with SA 706. So emphasis of matter paragraph should have a clear reference to a note in the financial statements. So that will be appropriately worded. Then comes the responsibilities of the management and those charged with governance for the financial statements. Auditor's responsibility for the audit of financial statements. Other reporting responsibilities, generally, these are not applicable in the case of a non-corporate entity. It will be a signature of the auditor, name of the firm, firm registration number, name of the partner proprietor, membership number of the partner proprietor, UDIN as per ICAI guidelines, place of signature, and date of signature. So I'd like to address some common issues in the audit report. Paragraphs relating to auditor responsibility and management responsibility are required to be included in Form 3CB. So where the auditor is auditing the financial statements and also issuing a report on Form 3CB, such report is given in Form 3CB. which has two parts. The first part is related to the audit of financial statement. The second part is related to Form 3CD. However, in the utility available on the income tax website, there is no option to change the format and layout. So these paragraphs should be added in the observations and comment section to ensure compliance with SA 700 revised. So this is very important. So in case only a tax audit is being done, even then these paragraphs need to be included because tax audit includes financial statements as well. Date of audit report cannot be prior to the date of approval of financial statement by the management. However, the date of audit report can be later than the date of approval by management. So this is from my side. Two tools available I mentioned earlier. Ready referencer on engagement and quality control standards and practitioner's guide to audit of small entities. So ready referencer on engagement and quality control standards has summarized the engagement and quality control standard in a simple form. The key aspects have been covered. So this will be helpful for the practitioners to go through instead of going through the entire text of the standards so far as audit of small non-corporate entities is concerned. However, this is not actually a substitute for the full text of standards in auditing. And there is a specific practitioner's guide to audit of small entities, which has various checklists, audit programs, and documentation tools. So this will also be very helpful in meeting the documentation requirements for the audit of non-corporate entities, particularly because most of these entities would likely be smaller entities. So I can be reached out on my email ID, pranajan@bgsc.co. Thank you from my side. I now request my fellow speaker, Praveen, to take it forward.
Thank you, Pranav sir.
Mhm.
And it's always a privilege to share dice with you. However, there is no matter left for me to deliberate upon, basically because you have covered auditing aspect very well. But I'll try
Thank
my
you.
best
Yeah.
to do my part.
So you are
So
covering actually two very important parts. One is the format of financial statement that is very important because a new requirement and accounting standards.
yes, sir, thank you. So should I share the screen?
Yes.
It's visible.
Yeah, it's visible now.
Yeah. So good afternoon, everyone, and thank you, Kajal and Swati, for a very kind introduction of mine and Pranav Jain. And thank you, Auditing and Assurance Board, for providing me this opportunity to deliberate upon very critical aspects about financial statements of non-corporate entities and applicability of accounting standards on non-corporate entities. So my presentation would be in two parts. One is about applicability of accounting standards on NCEs and about the format of financial statements. So as we are aware that the institute has come up with an publication technical guide on format of financial statements for non-corporate entities. So we will be covering those aspects also. So, however, Pranav sir has touched upon the format of non-corporate entities, but we will be covering them very quickly. So, there are 5-6 types of entities which can be classified as non-corporate. One is the sole proprietorship firms, HUF, partnership firms, whether registered or not registered, association of persons, that is body of individuals, resident welfare associations. So here comes the trust part also, and societies registered under any law for the time being in force. So these 5-6 broad categories are there to identify non-corporate entities. So, what is the general understanding of financial statements? So no standard format for presentation of financial statements by non-corporate entities before the institute has come up with this technical guide. Recognition and measurement principles laid down by accounting standards issued by the ICAI, recommendatory in nature. So this technical guide, which talks about the format to be followed by non-corporate entities, is recommendatory in nature. However, as a good practice, it is strongly recommended that every non-corporate entity should prepare its financial statements following this format. And since as the member of the institute, uh, the auditors must strive to sign the financial statements of NCEs in this format only, and can be applied by all non-corporate entities except where relevant laws, regulations, authority has prescribed any other specific format. So if there is specific format prescribed by the law under which that particular entity has been incorporated or formed, so then you may divert from the format and prepare financial statement following the format suggested by that statute or the law or regulations. Otherwise, members are advised to follow and sign financial statements of NCs in this format only. So financial statements form part of the process of financial reporting. So this is the general understanding of financial statements. So what all is included in financial statements? So we are aware about the fact that what are the components of financial statements, but let's revise them. One, the complete set of financial statements normally includes a balance sheet, a statement of profit and loss, a cash flow statement if applicable, and those notes and other statements and explanatory material that are an integral part of the financial statements. So it covers notes to account, significant accounting policies, and other explanatory material which is required to be given to the financial statements. So when I am saying other explanatory material, then it can be traced directly from a note regarding emphasis of matter provided by the auditors in their report. So if there is EOM in the financial statement, then there has to be an explanatory note into the financial statements by the entity, if the auditor has given EOM in it in his audit report. So the objective of financial statement is to provide information about the financial position. So the financial position, it comes from the balance sheet. The financial performance, it comes from statement of profit and loss, and cash flows of the entity, which obviously coming out from the cash flow statements. So why financial statements? So financial statements form a backbone for financing planning, analysis, and decision making by the stakeholders. So financial statement is the snapshot, as we have already discussed, that it gives an idea about the financial position. So when I'm saying financial position means what? It means the solvency situation of the entity. It talks about any problems in the financial position of the company. We are talking about financial performance, and then then it talks about profit and loss earned by the company during the period under audit, and cash flows. So it is the backbone. So if a stakeholder is not aware about the problems faced by the entity, and it is not aware about the profit and loss of the entity, he cannot make any informed decision. So it is a backbone. Second, there are wide user stakeholders of the financial information of non-corporate entities. And who can be the stakeholders? The bank, if the entity has taken loans, or any other investors. If the entity is a charitable institution, then the donors, then government, if the government grants are provided by the government to the entity. So there is a wide range of users of the financial statements. These users need financial information of reporting entities to make various economic decisions. We have already discussed about. If a non-corporate entity is going to seek any loan from banks, So then the bank need to understand the financial position, solvency position of the company, of the entity, and the entity's ability to serve the interest and the debt coverage. You can call it broadly. So these users need financial statements for various decisions, and economic decisions require an evaluation of the ability that determines the capacity of an entity to pay its employees and suppliers, meet interest payments, repay loans, and make distribution to its owners. So I have already discussed all these points earlier. So this is the importance of financial statements. And since there was no uniform format, there was no standard format recommended by any statutory body. So these entities were free to use whatever format they wanted to. But after this technical guide, so there is a standard format, and the entities and the auditors are advised to follow that. Applicability of accounting standards. So Pranav sir has covered the applicability of auditing standards while performing audit function of NCEs, and I in this session, in this part of session, will be covering the applicability of accounting standards. So for the purpose of applicability of accounting standards, entities are classified into 4 categories. Level 1, that is the large category. Level 2, that is the medium category. Level 3, the small category of the entities, and level 4, micro entities, for non-corporate entities. So these are the 4 levels which have been classified by the ICAI while applying the accounting standards. Level 1, non-corporate entities are required to comply fully with all the audit accounting standards. Level 4, 3, and 2, non-corporate entities are considered as micro, small, and medium, that have been granted certain exemptions, relaxations by the ICAI, and we will be covering in the coming slides that what are those relaxations, what are those exemptions provided by the ICAI to such entities. So let's understand the background and the classification criteria for this level 1, 2, 3, and 4. ICAI prescribed the criteria classifying entities as level 1, level 2, and level 3 in 2004. So there were only 3 categories, 3 levels in till 2020, when the threshold limits for classification of micro, small, and medium enterprises were revised by the Government of India through MSMED Act. So in 2021, ICAI announced revised criteria and classified non-corporate entities into 4 levels instead of 3 levels which were there before this announcement. So applicable in respect of accounting period commencing on or after 1st April 2020. So before the accounting period starting from 1st April 2020, there were 3 levels, and starting from financial year 2021, there are 4 levels which need to be evaluated. So this is the classification of entities listed or under process of listing. So for any entity, non-corporate entities, to be classified as level 1, the first criteria is the listing requirement. If the entity is listed or under the process of listing. So there can be a doubt in our mind that we are familiar about a company getting its shares listed on stock exchanges, but we are not familiar, or we have not heard about any non-corporate entities getting listed itself on any stock exchanges. So starting from 2018, the Government of India has announced social exchanges, where a not-for-profit organization or a charitable organization or a society for that purpose per se can list its units on the stock exchange. So now, if any non-corporate entity which has listed its units or its partnership interest on the stock exchanges, then it will be classified as level 1 without looking into other criteria of turnover and loans. So, and even if it is under the listing process, so and what does it construe? It construe that if the entity has filed draft papers or application with any stock exchange for listing, so then it will be considered as entity under listing, irrespective of the fact that its units have not been listed yet on the stock exchanges. The second criteria is banks, financial institutions, or insurance companies. So, though such type of entities are also classified as level 1, irrespective of their turnover or their borrowing criteria. So, for other type of entities which are not covered under about two parameters, so there are two criteria. One is of turnover, second is of borrowing. So for an entity to be classified as large entity, its turnover should be more than 250 crores in the accounting period, and borrowing should be more than 50 crores. So if the entity is having any of these criteria, it will be classified as level 1. And holding or subsidiary of any of the above. So in non-corporate entities, there again comes a person about being subsidiary or holding of any of the entity. But as we are aware that in a partnership firm, a company can be shareholder partner. So if the company has controlling stake over that partnership firm, so then it will be considered as level 1 because it is subsidiary, or it can be holding company of a company. A partnership company can be having, say that it's 90% shares of a listed company. So then it will be considered as level 1 irrespective of the fact that whether it is having turnover or not, requisite turnover or not, whether it is having requisite borrowings or not. For level 2, the medium one, so there cannot be listing or under listing situation. There cannot be any banks or financial institutions for an entity to be classified as level 2. So there are three criteria per se. One, that it has its turnover more than 50 crores but less than 250 crores, and it has borrowings of more than 10 crores but up to 50 crores, and holding or subsidiary of any of these two types of entities. Means if an entity is holding or subsidiary of any entity which is classified as level 2, will be classified as level 2 itself, irrespective of the turnover and borrowings criteria. And then comes the level 3 criteria, which is the small one, that the turnover is more than 10 crores but up to 50 crores, and the borrowings are more than 2 crores but up to 10 crores. And again, the third criteria of being holding and subsidiary company is applicable in this case as well. So now what is the level 4? That is the micro entities. So micro entities are the entities which are not covered under level 1, level 2 or level 3. So any residual entity would be classified as level 4, that is the micro category of non-corporate entities. So now let's see the applicability of accounting standards level wise. So there are 27 accounting standards. We all are aware of that. Accounting standard 6 have been taken back by ICAI. So now there are 27 accounting standards. So for level 1, all the accounting standards will be applicable in their entirety. Means the recognition criteria, the measurement criteria, and the disclosure part will be applicable on all the entities if they falls under level 1. And for level 2, there are 16 accounting standards which are fully applicable. There are 7 accounting standards which are not applicable. There are 3 accounting standards which are applicable with disclosure exemptions. Means the recognition and measurement criteria is applicable. The exemption is only for certain disclosures to be given into the financial statements. Applicable with exemptions is one accounting standard, that is accounting standard 15. Applicable for specific provision, that is AS 22, it is not applicable on level 2 entities. For level 3 entities, there are 12 accounting standards which are fully applicable. There are 9 accounting standards which are not applicable, and we will be discussing that which all accounting standards that are applicable fully across the level, and which are the accounting standards which are not applicable across the board, and which are the accounting standards which are applicable with certain exemptions. Either it is related to disclosure, it is related to recognition or measurement. We will be covering those aspects in the upcoming slides. And for level 4, there are only 8 accounting standards which are fully applicable. There are 11 accounting standards which are not applicable in their entirety. And there are 6 accounting standards which are applicable, but with exemptions from disclosures. Applicable with exemptions, that is AS 15 is also applicable with exemptions. And accounting standard 22, it is not applicable per se. And as per the framework of accounting standards by ICAI, accounting standards are applicable on the entities which are involved in commercial or industrial or business activities. So if any non-corporate entity which is 100% religious or charitable in nature, which is not involved in any type of commercial activity, so there will be no applicability of accounting standard on such type of entities. So it is coming up from the framework upon accounting standard issued by the ICAI. So we have to take cognizance of this fact also while identifying the accounting standards which are applicable on any NCE. So these are the accounting standards, as we have discussed, that the 8 accounting standards which are applicable across the levels. So these are the accounting standards which are applicable. The accounting standard 1, disclosures of accounting policies. Accounting standard 2, valuations of inventory. Accounting standard 4, contingency and events occurring after the balance sheet date. Accounting standard 5, net profit or loss for the period, prior period items and changes in accounting policies. Accounting standard 7, construction contracts. If the entities are doing any construction contract or are involved in such activities. Revenue recognition, it is applicable on all type of accounting or non-corporate entities. Accounting for government grants. Accounting for borrowing cost, that is accounting standard 16. So these are the 8 standards which are applicable across all levels. Accounting standards which are not applicable in their entirety on the level 2, level 3 and level 4 are as below. Accounting standard 17, that is segment reporting. So segment reporting is not applicable on level 2, level 3 and level 4. Accounting standard 20, earning per share, it is again not applicable. Accounting standard 21, consolidated financial statements. So if you can see that there was a criteria of being holding or subsidiary of a level 2, level 3 or level 4 entity. So even if you are holding of any level 2, level 3 or level 4 entity, and you are classified as level 2, level 3 or level 4, but still accounting standard 21 is not applicable on you, means the entities, the non-corporate entities falling under level 2, level 3 and level 4, even if they are classified as holding of any entity, they are exempted from preparing consolidated financial statements. It is a very, very critical and important aspect to understand here. And then accounting standard 3, that is the cash flow statement. It is not applicable on 2, 3 and 4 level entities. Accounting standard 23, accounting for investments in associate in consolidated financial statement. Since we are not preparing consolidated financial statements, then there is no question of following AS23, that is the equity method of accounting for associates and JVs in certain cases, and accounting standard 25, interim financial reporting. It is again not applicable. AS27, financial reporting of interest in JV. So AS21, 23, 27, these are three brothers which are applicable either in their entirety or not. So these are not applicable, as there is no need to prepare consolidated financial statements by level 2, level 3 and level 4 entities, irrespective of the fact that they have been classified as holding of any other entity. So then there are certain accounting standards which are applicable but with certain exemptions, either related to recognition or measurement criteria or the disclosure criteria. AS10, property, plant and equipment. There are certain disclosure exemptions for level 3 and level 4 entity. So what does it mean? It means that AS10 is applicable in its entirety on level 2 entities also. But there are certain disclosure exemptions for level 3 and level 4 entities. AS11, the effects of change in foreign exchange rates. Again, it is there are certain exemptions from disclosures for level 3 and level 4 entities, but it is applicable on level 2 entities. Accounting standard 13, accounting for investments, disclosure exemptions. Then there are disclosure exemptions for level 2, level 3 and level 4 entities. AS15, certain exemptions. So in AS15, there are certain exemptions related to recognition and measurement criteria, which with disclosure requirements. AS19, disclosure exemptions are there for level 2 and level 3. For level 4, there are certain recognition and measurement criteria also, which is exempt. AS28, impairment of assets, disclosure exemptions. AS29, provisions, contingent liabilities and contingent assets, again disclosure exemptions. So whenever I am saying that there are exemptions related to disclosure, then I mean to say then the entity has to follow the recognition and measurement criteria described under that particular AS. So what does it mean? When suppose we are talking about AS29, about provisions, about showing contingent liabilities into the financial statements in notes. So it means that even level 3 or level 4 entities are required to create provisions, required to show contingent liability in their notes to accounts, but they are exempt from certain disclosure requirements, which we will be discussing one by one in the upcoming slides. So far AS10 is concerned, we as we have already discussed that there are certain exemption only for level 3 and level 4 entities. And what is the exemption? That para 87 of AS10 is not applicable on level 3 and level 4. And what does this para say? It says that an enterprise is encouraged to disclose the following: the carrying amount of temporarily idle property, plant and equipment. So suppose there is a factory which is currently not operational due to certain reasons. So AS10 talks about disclosure about this fact into the financial statement. The disclosure can be right below the schedule of property, plant and equipment, or it can be at any place into the financial statements under notes to the financial statements. Second, the gross carrying amount of any fully depreciated property, plant and equipment that is still in use. So there are cases that, and we all are aware that the useful life and economic life of the assets are different. So the asset can still be in use even if its useful life has been passed, or the useful life is completed. So still that that asset can be in use. So there are many examples of such cases, like we are using laptops or desktops in our day-to-day practices, and the life prescribed under Companies Act is, if I'm not wrong, is 3 years for laptops or desktops. But we are aware that many entities are using laptops even after 3 years, even after 5 years, if they are into the workable conditions. So AS10 encourages, so it encourages the entities to tell about such assets whose economic life has, whose uh, useful life has been completed, and they are fully depreciated, but they are still in use. For each revalued class of property, plant, and equipment, the carrying amount that would have been recognized had the asset been carried at post-mortem. Means we are all aware that for companies particularly, if the entity, if the company is following revaluation model, then it has to show what the actual cost of the asset, and it has to show the WDV every year, had the company not gone for revaluation model. But here for level 3 and level 4, such type of disclosures are not required, and such entities are exempted to disclose such figures. And the carrying amount of property, plant, and equipment retired from active use and not held for disposal. So we need to understand here one very, very important aspect of this disclosure, that if the asset is not in active use and it is held for disposal, so then AS10 requires to show such assets as current assets in the name and style of assets held for sale. But if those assets have not been held for disclosure or disposal, means they have not been particularly identified to be disposed of, but they are retired from active use. So in such cases, level 3 and level 4 entities are exempted to show them or to disclose them in such conditions, either just below the note of property, plant, and equipment, or somewhere else into the notes to accounts. So these are the disclosure exemptions which are given under AS10 for level 3 and level 4 entities. Then AS11. So the disclosure is also encouraged of an enterprise's foreign risk management policy. So every entity which is exposed to foreign currency risk has to provide currency risk management policies. Means whether they have taken future contracts, whether they have has their foreign currency exposure or not, and they have to disclose the unhedged portion of foreign currency exposure, means the receivables, the payables in foreign currency, if they are unhedged. So they have to show it into the financial statement. But for entity 1, for entities under category 2, level 2, level 3, level 4 are exempted from providing any disclosure on foreign currency risk management policies. So objectives of foreign currency risk management policy, though I have already discussed, but let's read them out again. To manage risks to the budgeted cost and revenues from adverse impact of currency fluctuations, to reduce the rupee cost of the company's foreign currency payables. So means it is advised that the entities should hedge their payables and receivables to achieve results better than that what would result from a passive automatic 100% hedge policy, to reduce the cost of funding by raising foreign funds directly or through approved instruments, to reduce transaction cost and bank exchange margins. So these are the objectives of foreign currency risk management policy. But since level 2, level 3, level 4 entities are exempted from the foreign currency risk management policy and its disclosure, so there is no need to provide such disclosures into the financial statements. Then under 13, There is disclosure exemptions. It is available to level 4 entities only. So I have been very specific about the exemption, whether it is applicable to all three levels, or it is applicable for any particular one level. So other disclosure as specifically required by the relevant statute governing the enterprises means we know that there are certain disclosures to be given under AS13, but every accounting standard talks about that if there are any particular disclosure requirements falls under any particular statute governing the entity, then those also needs to be disclosed. But for category level 4 entities, such type of disclosures are not required to be given under AS13. So then AS14, the employee benefit, AS15, employee benefits. So it is it provides certain exemptions to level 2, level 3, and level 4 entities. Average number of, and the criteria of this recognition and measurement is dependent upon number of persons employed in the organization. So if the average numbers of person employed is 50 or more, so then the exemption is provided from para 11 to 16, which talks about recognition of liability for short-term accumulated compensated absences, which are non-vesting. So there is no need to recognize liability for short-term accumulating compensated absences, which are non-vesting. Second, para 46 and para 139, those paras talks about discounting of amounts that fall due more than 12 months from the balance sheet date. So we all are aware that for employee benefits, particularly related to gratuity and leave encashments, we used to take actuarial reports, and any liability which falls beyond 12 months need to be recognized following the actuarial's report, and actuarial reports used to discount the liabilities which falls beyond the 12 months period. So since we are not we are category we are level 3, level 4 entities, so we are exempted from using this discounting. So what does it mean? It means suppose I run an entity, and then entity is having employees is having 60 employees in any particular year on an average. I have to provide for their liability on, say, that is on EL part or on gratuity part. And as a going concern, I assume that none of the employees is leaving the company within 12 months. So I have to recognize the liability, but I need not to discount those liabilities, which I assume that they will be paid after 12 months. So this is the exemptions provided for such type of entities. Para 52, para 123, and para 129 to 131 of AS15, which talks about accounting for defined benefit plans and other long-term employee benefits. However, such entities shall follow the following. Means you need not to follow these paras in their entirety, but still you need to account for these things. Means there is an exception to exemptions. So there is the entities are exempted from following the principles described under para 50 to 123 and 129 to 131, but with certain exceptions. So it is a proviso to proviso. And what does it say? It says that provide for accrued liabilities based on actuarial valuations. Means if the entity is having more than 50 employees on an average, it has to obtain actuarial report. For defined benefit plans. And what are the defined benefit plans? Defined benefit plans are plans wherein employer contributes a definite amount based on certain criteria, and the employer is not responsible for any shortfall while paying uh, employees employees share, say that is gratuity. So gratuity is classified as defined benefit plan. Means employer is paying a particular amount every year on part of gratuity. But if that funds fall short in paying gratuity to their employees, so employer is not responsible. So this is the definition of defined benefit plans. So for defined benefit plans, every entity across the board has to obtain actuarial report. Use PUCM to determine such liability. And we are aware that if the entity is required to take actuarial report, then actuarial follow PUCM method. And what is PUCM? It is projected unit credit method. So I am not going into the detail because this method in itself will take an hour to describe and to discuss. Then use of discount rate which with reference to market yield at balance sheet date on government bond. So actuarial used to take discount rates. Why? Because the liability is futuristic. And since every organization prepare its financial statements following the going concern, so it is assumed that the employees will continue with the company for near future. So if they are going to continue, means the entity has to pay this liability beyond the period of 12 months. And if the liability to be paid beyond the period of 12 months, it needs to be discounted. And if it needs to be discounted, then on what by which rate it will be discounted. So the discount rate would be the market yield on government bonds. Why this? Because this is the safest and risk-free rate to use for discount. Otherwise, for taking entity specific discounting rate, it will have its own complexities. How to calculate, which rate to be taken. So to avoid the complexity, we can take risk-free rate, which is the rate of government bond, coupon rate on government bonds. Disclose actuarial exemptions. So here, entities need to disclose what are the actuarial exemptions. And what are the actuarial exemptions in general? That is the mortality rate, what is the retirement age, what is the expected increment year on year in employee salary. So these are certain exemptions upon which actuarial calculates gratuity or leave encashment liabilities for the entities. The second aspect is if the entity is having employees less than 50 on an average. So then what are the exemptions provided for such entities by the AS 15 for level 2 and level 3? So for level 4, it is not applicable per se, but for level 2 and level 3, these are the exemptions. Para 11 and para 16, short-term accumulated compensated absences which are non-vesting. It is the same as in the earlier case. Para 46 and para 39, discounting of amounts that fall due for more than 12 months. Again, there is no need to discount it. And para 52, para 123, para 129 to para 131, these are the same paras, but there is a catch. So as I have discussed that there are provisos to the proviso. So here in this case, entities need to follow the following, means provide for accrued liability. Means if the entity fall under level 2 or level 3 and it has average employees lesser than 50 during the year, so then it need not to take actuarial valuation, but it need to calculate the liability related to defined benefit plans and long-term liability. So how that will be calculated? Then such liabilities will be calculated on actual basis, on accrual basis. Means suppose an employee has completed 5 years with the entity and its last drawn salary is 50,000 per month. So then we are aware that there are two types of entities. One which fall under the Gratuity Act, one which will not fall under the Gratuity Act, and then there is a formula of 15/26 for the entities which fall under Gratuity Act, which does not fall. There is a formula of 15/30. So I am assuming that the entity is falling under Gratuity Act. So by following the formula, so then the liability will be calculated as 50,000, which is the last drawn salary, into 15/26 into number of completed years. And when we say number of completed years, so then any year or the part of year where the employee has worked more than 6 months. So if the employees have worked for 5 years and 8 months, then the liability should be calculated for 6 years. So 50,000 into 15/26 into 6 years. So the entity has to calculate the liability by following this formula. If it is related to compensated absences, that is the leave encashment, then what are the leaves available with the employees which will be paid on the balance sheet date, and what is his last drawn salary. So that will be multiplied. The last drawn salary will be multiplied by with the number of days which are in the credit of the employee's account. So every entity level 2 and level 3 needs to calculate the liability, but on the actual basis or the accrual basis. May use other rational method. Other rational method, though those are not prescribed anywhere, but that, for example, a method based on assumption that such benefits are payable to all employees at the accounting period. The same thing which I have been discussing, or which I have already discussed. So these are the exemptions for level 2 and level 3 under AS 15. Then AS 19 leases. So there are certain disclosure requirements. So for level 2, level 3, level 4, para 22, sub para C, E, and F, which talks about reconciliation and period-wise classification of total of future MLPs and PVs. MLPs means minimum lease payables over the period of the lease, and PVs present values of that asset. So there is no need to provide period-wise reconciliation of these two items. Second, total number of MSPs expected to be received under non-cancelable leases. MSPs means maximum selling price at the end of the lease period. So there is no need to provide what would be the MSP at the end of the lease period. General description of the terms of significant leasing agreements. So when I am saying general description means what is the tenure of the lease period, what are the restrictions on the use of the assets, if any, what is the lock-in period, how it can be cancelled by both the parties. Such type of descriptions need not to be given. Para 25, A, B, and C, which talks about period-wise total of future MLPs expected, and these are related to finance lease and operating lease. So for finance lease, para 22, for operating lease, para 25. Both talks about the same thing. So I am not repeating it again. The reconciliation between MLPs and PV, MSP, and journal description. No need to disclose. Para 37, disclosure by lessor. So earlier, the para 22 and 25 were talking about lessee, accounting by lessee. 37 and 46 are talking about accounting by lessor. So disclosure by lessor for finance leases, a reconciliation of period-wise reconciliation, again PVs and MLPs. But why? You can see the difference. Earlier, I used MLP first and PVs later. Here I am using PV first but MLPs later. Why so? Because for a lessor, the present value of the asset is more critical than MLP. For him, present value means what? The present value of the asset. MLPs means the lease payments over the period which he is supposed to receive, he or she is supposed to receive. So I, as a lessor, is more concerned about covering the cost. So that is why I am reconciling my PV with MLPs. But as a lessee, I was more concerned about the lease payments in comparison to PVs. So this is the only difference. Otherwise, both the terminologies remain same. Journal description of terms of significant leasing agreement. Again, it is not applicable on lessee, which it is not applicable on lessor. Accounting policy for initial direct cost. Since I have bought the asset is owned by the lessor per se, but there is no need to provide the accounting policy for initial direct cost. It is exempt. Para 46 is again talks about lesser, but for operating leases, period wise total number, total of future MLP, and journal description. So there are these exemptions you can say. Then AS22. AS22 talks about recognition, measurement, presentation, and disclosure exemptions for level 4 entities. Means it is applicable on level 2 and level 3. So para 4.4, current tax is the amount of income tax determined to be payable in respect of taxable income for a period. So everybody knows it. So current tax is what? It is a tax liability for current period. So it is need not to be shown under level 4 entities. Para 9, tax expenses for the period comprising current tax and deferred tax. What does it mean? There is no need to calculate deferred tax also for category 4 or level 4 entities. Para 20, current tax should be measured at the amount expected to be paid. The taxation authorities using the applicable tax rate. Again, it is in addition to para 4.4, but talks about same thing. Para 27, 28, current tax assets and liabilities should be set off only when the entity, means there is no provision of setting off the current tax expense liability. Why? Because I am not supposed to create provision even for taxation. So there is no need to create provision. So there is no need to provisions related to set off of current tax with current liability. So these are the exemptions under AS22 for level 4 entity. AS26 intangible assets. It is again only on entity 4 level 4 entities. Para 90D, the financial statement should disclose the following for each class of intangible assets, distinguishing between internally generated intangible assets and other intangible assets. A reconciliation of carrying amount at the beginning and end of the period. What does it mean? It simply means preparing the depreciation schedule for intangible assets. Means opening, accumulated depreciation, amortization for the period and closing period, and the WDV at closing period. Impairment losses recognized in the statement of profit and loss, no need to show. Impairment losses reversed in the statement of profit and loss, no need to show. So these are the exemptions for entity 4, level 4 entities. And para 98. An enterprise is encouraged but not required to give a description of fully amortized intangible asset that is still in use. So this you can trace from the requirement of AS10, which we already discussed. It is not applicable on level 3, level 2, level 3, and level 4 entities. Impairment of assets AS29, 8. It is again not applicable on entity 4, but it is applicable on level 2 and level 3 with certain exemptions, which we will be discussing. Allowed to measure value in use on the basis of reasonable estimate thereof, instead of computing the value in use by present value. What does it mean? So we are aware that value in use is the higher of value in use calculated using the future cash, discounting future cash flows, or by other means. And what those other means are, if the entity is having any quotation for selling that asset on that date, means the selling price, the net realizable value for that asset, and the present value of value in use calculated based on future period. For level 2 and level 3, there is no need to calculate value in use by using future cash flows. Means you can simply use the net realizable value of that asset as value in use. Disclosure exemption available to level 3 entities. Here it is applicable on level 3, means level 2 needs to disclose the disclosure requirements, but for level 3 there is exemption, means para 121, if the impairment loss for an individual asset or a cash generating unit is recognized or reversed during the period and is material to the financial statement of the reporting enterprises as a whole, an enterprises should disclose for an individual asset or the reporting segment, means there is no need to disclose impairment loss and reversal thereof in the case of level 3 entities, but in the case of level 2 entities there needs to be disclosed. So these are the exemptions which are provided under AS 28 for level 3 entities. Now the last accounting standard, AS 29, provision contingent and liabilities. So for level 2, level 3 and level 4, there is no need to give reconciliation of provisions, means the opening balance, additional provision created, amounts used against provisions, unused amounts of provisions reversed. So there is no need to provide reconciliation. Para 67, for each class of provision, an enterprise should disclose a brief description of the nature of the obligation. Sorry for disturbance, I take 1 second. Sorry. For para 67, for each class of provision, an enterprise should disclose a brief description of nature of the obligation and expected timing of any resulting outflow. So here there is no need to disclose the expected timing, the expected amount of outflow, an indication of the uncertainties about those outflows, and the amount of any expected reimbursement, stating the amount of any asset that has been recognized for the expected reimbursement. So these are the exemptions provided for level 2, level 3 and level 4 under AS 29. What does it mean? So there is no exemption from recognition and measurement. So every entity has to recognize a provision if the recognition criteria are met, and they have to be subsequently measured following the measurement criteria as prescribed under AS 29. So this is the first part and most critical part of financial statements for non corporate entities, and now I will be covering quickly in 5 minutes the financial statements. So these are the general instructions. Disclosures are required in the relevant statute, shall be made into the notes and accounts. Each item of the on the face of balance sheet and statement of profit and loss shall be cross-referenced, and the financial statements should be rounded off. If the total income is less than 100 crore, then into the nearest hundreds, thousands, lakhs, millions, and decimals thereof. And if the turnover is more than 100 crores, then to the nearest lakhs, millions, and crores. Once the unit of measurement is used, it should be used uniformly, and the disclosure requirement recommended in the format should be disclosed into the accounting into the financial statements. So now I am opening the format of financial statements for the benefit of larger group. Is my screen is still visible?
No, sir, it's not visible.
I am opening the pro forma financial statements as suggested by the technical guide and sharing those for. Is visible now?
Yes.
Yes.
So these are the financial statement. This is the format for financial statements, and we can easily see that it is the replica of financial statements for financial statements as prescribed in Schedule 3 of Companies Act. So almost all the items are same, definitely with the certain differences. So that in the case of shareholders fund, here the terminology used is owner's capital account. Reserve and surplus stands for particular reserves if required by any particular statute, or the profit and loss or the profit or loss portion of accumulated profit and loss for the earlier year, including the current year's one. And then long-term borrowings, deferred tax liability, if applicable, other long-term liabilities, long-term provisions, short-term borrowings. So the format remains same with certain differences, and required for non-corporate entities. The terminology may be a little bit different, but the format is largely based on the uh, 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 formats prescribed in Companies Act Schedule 3. So here is again the current and non-current uh, uh, definition of assets and liabilities applicable. Assets and liability needs to be classified based on the operating cycle or their recoverability and payable timings into the current and non-current. And the statement of profit and loss, again, it is the same as per the format for corporate entities. The one difference you can see is that comparative figures needs to be disclosed. So earlier I have seen that in many cases, when there was a financial statements of partnership firm or an individual or trust or societies were prepared by the company, by the entities, they were preparing for current year only. So there were no comparative figures. But under this, though this format is recommendatory, but being the member of institute, since it is a technical guide, I believe we must follow it religiously, without any exemption, without any exception or failure. So now we need to provide for the comparative figures also. Then the significant accounting policies, background of the entity in note 1, in note 2, significant accounting policies, and why significant. Only the accounting policies which are material and significant and relevant to the entity needs to be disclosed. So there is no need to provide for the accounting policy related to each and every accounting standard. So owner's capital again, name of the partner or proprietor or trustee, as the case may be, share of the profit, opening balance as on first day of the financial year, capital introduced or any drawings, remuneration taken, interest on the capital, if any, withdrawal. So such type of reconciliation related to owner's capital needs to be provided, as in the case of share capital in the case of companies. Obviously, there is no concept of drawings, so that is why there is not a mention of remuneration or withdrawal in the case of companies. That's what I said. With certain differences, the format broadly remains same as in the case of companies. So then the notes to the financial statements related to balance sheet, items of the profit and loss account. So this is all from my side, and now we are open for questions. Thank you.
Thank you, Pranav ji and Praveen ji, for such a knowledgeable session. It was really helpful for all of us. So now we can proceed with the questions. So we have few questions from the participants. The first question is that whether keeping Xerox copy of bank account statement for the whole year or in PDF format constitute audit documentation
Generally, we keep closing balance certificate as on 31st March.
Yeah. So technically, it is not an audit documentation unless you have performed certain procedures on those bank statements. Normally, a balance confirmation for the period end should be a normal audit documentation. So maybe at times you may take a copy of bank statement where you have traced the payments or collections into the statement. Maybe on a sample basis you can keep, but keeping the entire statement is not audit documentation.
Thank you, sir. And next question is, what precautions should be taken in preparation of housing society?
So far, auditing standards are concerned, Pranav sir has already spoken in length on that part. And so far, the format of financial statement is concerned. So, if you remember, in the starting of my session, I said that cooperative societies, residents' welfare associations, all are considered as non-corporate entities. So whatever the discussion, either on auditing part, on accounting standard, or on the format of the financial statements, that is applicable on cooperative societies also.
So the next question is this: the whether audit report other than Form 3CB required if tax audit is on different date and financials are finalized and signed before the tax audit due to client has to submit to a bank or FI for a loan purpose.
Uh, yeah, right. So, okay. So these are two parts. One, if you're submitting the financial statement to a bank with audit report, that audit report will be as per the format in SS 700. Uh, but since the audit has not been conducted under any other law, you will necessarily be required to issue Form 3CB. And Form 3CB has two parts, one on the financial statement and then on the 3CD. So in this case, there will be two different reports that will be issued to the entity.
Thank you, sir. And next question is, do toilet trusts or societies also get covered under the four level of accounting standard disclosures? I think it is.
Yeah, definitely. But
Yeah.
the framework of accounting standards talks particularly about this issue. So, if the charitable trust is not doing any commercial activity, which is very, very difficult to differentiate between commercial activity and charitable activities. So, we can take an example of a school. So, school is, accepting fees from students and rendering education, training, coaching to the students. Though the objective by law is not for profit, but still it is having commercial aspect, means accepting the fees and delivering the services. So if such type of situation is concerned, then the applicability of accounting standard is as per the level of that entity, or that religious education trust or religious trust, whatever the case may be. But if it is 100% charitable, not doing any commercial activity, then there is no applicability of accounting standards. But again, it is very, very difficult. So the members needs to apply cautions very, very cautiously. So cautions with the cautiousness, I would say.
Thank you so much, Praveenji. So the next question is this: how do auditor evaluate the going concern assumption in non-corporate entities, and what specific factors should they consider as compared to the corporate entities?
Assessment of going concern for non-corporate entity is similar to that for a corporate entity. There is no difference because the basic concept of going concern remains same. So, so it'll have to, basically what are the indicators highlighting to a going concern issue and what are the mitigating controls or the uh, mitigating process that the non-corporate entity has put in place. So like a corporate entity, you will need to have a cash flow projection at least 1 year from the end of the financial year and perform all of the procedures. So, as I mentioned earlier, the auditing standards apply as it is to a non-corporate entity as to a corporate entity. So there is no difference. And even if we go by the accounting standards, AS1 very clearly talks about going concern as a fundamental accounting assumption. So technically, there is no difference.
And the next question is, what are the best practices for documenting and communicating audit findings in the non-corporate entities?
So again, the audit is as per auditing standards. So all the auditing standards will be applicable to a non-corporate entity. So the documentation will be covered by SA 230 and any other requirements of the communication with those service governance. If you want to identify, highlight key matters to those service governance, that will be as per 260 or 265 as the case may be. So there is as such, no difference in the audit of a corporate and non-corporate entity. If you ask me, the only difference lies in the application of accounting standards, in the application of the format for financial statements, and the basis of accounting, the cash basis of accounting, as compared to accrual basis of accounting in case of corporate entity. Otherwise, the procedures remain same. The only difference could be based on the size of the documentation requirements or the application of auditing standard may be limited, but that will be the case even for very small companies.
Thank you, Pranavji. Thank you, Praveenji. So we are done with the questions. So at the end, I would like to, sorry.
Kajal madam, any question from your side? Kajal
Yeah,
madam, can you hear me?
I have asked that.
Okay, you are done with your questions?
Yeah.
ठीक है, ठीक. So thank you so much,
So-
everyone, on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India. I extend my heartiest thanks towards CA Pranav Jain ji and CA Praveen Kaushik ji for sparing their valuable time. Apart from having the busy schedule, busy meetings, they have given us time to for the sake of our members and shared his expertise. So thank you so much on behalf of AASB of ICI for the wonderful deliberation. And both of the learned speakers have enlightened all our members with their expert expertise. Thank you so much, Pranavji. Thank you so much, Praveenji, for their
Thank you, now. Thank you, Anandji.
experiences
Thank you,
shared.
everybody.
Thank you.
I
Thank
also
you,
thanks
Kajal.
both the moderators, Kajal Garg madam and Swati Kapoor madam, for wonderfully moderating this webinar and sparing their valuable time. Thank you so much, Kajal madam. Thank you so much, Swati ji. And I also thanks all the participants of today's webinar who have joined and in the morning time and gained a lot from our both learned speakers. So thank you so much, everyone. Thank you so much. Namaste.
Thank you.
Thank you.
Thank you, everyone. Yes.